Let's talk about real estate syndications as opposed to direct property ownership. I think the biggest misconception about investing in real estate syndications is that many investors assume they can use depreciation deductions from syndications to offset their W2 income. Can you use depreciation deductions from syndications to offset your hospital or active income?
You know, that's what a lot of syndicators push. A lot of them talk about the tax benefits of investing in real estate, but when it comes down to the nitty gritty of can you actually use the losses from a syndication to offset your W-2? No, the answer is no, because you have to meet those loopholes and those rules that we talk about for managing a short-term rental. Now, interestingly enough, for the doctors that own a practice, but they are considered passive. So let's say I invest into you own a practice. Let's say I invest into it as a passive investor. If I'm considered passive in that investment, I can actually use the losses from a syndication to offset that stream of passive income. It's a very advanced strategy. But if you're a doctor and let's say you own 10 practices, but all of them you don't actually step foot in or run the day-to-day operation, you're considered passive, and therefore you can use a syndication loss to offset that income. But for the majority of people, they're not able to use the syndication losses to offset their W-2 or active income.
Excellent. What are some other risks associated with real estate syndications?
I think one of the biggest risks I see that people don't talk about enough is the opportunity cost of doing it yourself. Like, you know exactly what you're going to get into with the syndication in terms of what you're getting from tax benefits. For the most part, the syndicators, in most deals, they're capping your upside because as soon as the value of your shares or ownership become 2x your investment, the average syndicator is refinancing the property and cashing you out. So to me, the biggest risk in the syndication becomes, well, what could you have done differently with the money? Like, could you have bought your own property or your own real estate, had your 100% of the appreciation, had all the tax benefits? You get to have control and get a say, because as a limited partner, you have zero say in what they do with the property. You could complain and ask all you want, but you have no say in what they do with the property, and that's just the role that an LP faces. So there's a lot of risk that come to being a limited partner. I would say, like I said, you don't have any control. Your upside is inherently capped because as soon as they double your equity, they're going to try to cash you out in some shape or form. So those are kind of off the cuff of my head. Those are some of the risks that I see with syndications.
Yeah. So just to recap, like what you say, limited control over investment decisions. That's a big one, right?
Mm-hmm.
Investors in syndications typically have limited say in the operational and strategic decisions related to the property, which are primarily made by the syndicate. And I
you'd be lucky if they even ask you your advice or your thought. They're just going to, and in most operating agreements, the general partner has the management and executive decision.
True.
Yeah.
And what are your thoughts on potential for, kind of conflicts of interest and management fees? Because that's another, I think, important one that I hear from investors, on a weekly basis.
Yeah, the syndication model, if you think about it, there's a lot of upfront costs that are associated with the syndicators having to find the deals, vet the properties, travel, talk to banks, talk to lenders, contractors, etc. So in most of the cases, they're going to charge some kind of upfront management fee, or they call it like an acquisition fee. Now, in most cases, the investor or the general partner is not taking that fee home with them. Instead, they're almost rolling it in the deal, so to speak. But I would never invest in a syndication unless the general partners were actually putting money out of their own pocket into the deal, or they were signing a personal guarantee on the loan. One of those two, both preferred. But as a limited partner, I can't I can't say that they have a real deep interest in my money if they're also not putting their money up at the same time. And a lot of deals are structured in a way where the limited partners are bringing all the money and essentially taking all the risk, and the general partners aren't putting up any capital other than attorney fees or a couple of closing costs. So the conflict of interest is definitely there between LPs and GPs, and it's important as an LP to find a GP that also has skin in the game.
Very interesting. But let's be fair and, like, talk about also benefits of the real estate syndications, right? It gives you the opportunity to access to larger projects. That's one of them, right? Diversification is another, like an aspect of it. But what are your thoughts on that in terms of benefits of real estate syndications?
I mean, there's pros and cons with everything, and this is not a message to say don't do a real estate syndication, because there's benefits. I mean, the biggest benefit, which is the first benefit that I listed for not doing real estate syndication, is opportunity costs, because the average person we see has got $400,000, $500,000 sitting in a bank account, barely keeping up with inflation. Well, outside of your regular, let's call it a year emergency fund, maybe $150,000 in cash, it's not wise to keep money sitting there in a bank account doing absolutely nothing. Your job as somebody who wants to build generational wealth and eventually not have to work all day every day is to make the money work for you. So a step above just putting it in a bank account or under your mattress could be investing it in a real estate syndication and getting a 7 to 8% return. And why you do a real estate syndication as opposed to the stock market is because there's less volatility in a real estate syndication. So if you were to ask me, hey Ryan, you have 7-8 years to you have this money and you need to make more money within 7 to 8 years, I'd rather pick a real estate syndication over the stock market. Now the stock market tells us over time the market makes money, but in a 5 to 7 year period, the jury is still not in on whether or not you can make money investing in the stock market over 5 to 7 years. That's not a long enough time horizon if you really need the money. But if you're trying to build up passive income streams and you need that money to last, the real estate syndication is typically a better investment vehicle than stocks.
Okay. That makes sense. But let's also talk about the advantages of direct property ownership, right? Because there are, like kind of unique advantages of the ownership. And you already, like kind of touched it a little bit, but maybe you can tell us a little bit more about the tax benefits, big, advantage. But let's talk about the direct property ownership benefits.
Yeah, owning your own property as opposed to syndications, I mean, there's benefits both numbers wise and non-numbers wise. So non-numbers wise is you obviously get to make all the decisions and the say. Now, that can be a benefit or a con when it comes to managing the property, right? You're the one that has to hire the management team or hire a property manager, but you get to make control and decisions over, when do we refinance? Do we raise the rates? When do we sell the property? When do we take it down for the winter? Like, you get to make all these decisions that you don't get to make as a limited partner. We talked before, you're more likely to be able to fully utilize the tax benefits to your advantage as a person who has a direct ownership of a property than if you were in an LP. Most of the time as an LP, you're only able to use the tax benefits if you already have other real estate activities going on. So a lot of our clients they'll manage, let's say they buy 2 or 3 rental properties. They figure out it's a lot of work and it's not really for them, but now they have all this money coming in, and especially our people in California where they're in the operating room all day making a high income. They got money coming in from real estate, and it's not out of the ordinary for them to have to pay 50% in taxes, right? So I get clients all the time, especially last year, that came to us and said, well, man, I don't really want to buy real estate at a 7% interest rate. And, they had a $250K income stream coming from 4 or 5 rental properties. They're like, I don't want to buy real estate at 7% interest rate, but do you really want to give 50% of that money to the government? And that's why you buy more real estate and get these tax benefits, so that way you can hold on to that 50% that you were going to give to IRS in California, and you do that through direct ownership as opposed to syndications.
Mm-hmm. No, these are all great points. So
and I could chat a little bit more about them too. I mean, we mentioned control, but then that equity appreciation. So there's a cap to what you're going to earn as a syndicate or as a limited partner, because they're eventually most likely going to cash you out, typically at a 2x. We call it a 2x equity multiple. So I invest 100 grand in year one, maybe I get cash flow of 5,000 to 6,000 a year for 5 years. But as soon as they can cash me out for 2x or whatever I put in most operating agreements, you're able to be cashed out and you're sent on your way. And that can kind of create chaos sometimes, because most of the time that's a taxable event for you as an investor. God forbid that you get cashed out on December 26th, 2024, or whenever the date is, because then you have 4 days to decide what you want to do with that money if you don't want to pay taxes. And that's why having direct ownership is better, because you get to make the say. Because if I'm somebody right now in December trying to sell a property, I'm telling them to push it back till January. Why? Well, then they have an entire year to figure out what they want to do to help offset it. And worst case scenario, if they can't, well, they don't pay the tax bill till April 2026. Yeah.
Totally makes sense. I think the bottom line is, before you invest, it's critical to understand how this works, so you can set realistic expectations and maximize the benefits of syndication deals. I mean, that's where it really boils down to.
And the one thing we haven't talked about yet is time, right? So time is the one thing that you can never get back. And I've seen a lot of investors who have gone the wrong way on each side. I've seen investors spend way too much time buying a $300,000 rental property that nets 20 grand a year, when they should have just taken that money and put it into syndication, right? I'll never forget, like I had a client of mine that wanted to replace a $400,000 a year income stream buying properties, and I'm like, well, 15 or 20 more of these and you'll have what you need to retire, because these $300,000 cabins are only making 15, 20 grand a year. So people aren't factoring in time a lot. And if you're making a high wage, you have to think about the time that it takes to operate these.
Yeah. Of course, there's certain amount of time associated with managing each property, right? Mm-hmm. So it boils down to how much time you have and what, like the ROI or, like the returns on each property. So you have to, like kind of study different options and make, like an educated decisions. Otherwise, you're just creating extra work for yourself. I mean, that's how I look at it, mm-hmm. rather than, like significant revenue streams.
Yeah. I'm not a surgeon, but as a CPA, I make an hourly rate equivalent to a surgeon. I'll say that.
True.
When I run numbers on properties, not only am I running the numbers from a cash perspective, a net profit, I'm also factoring in how many hours is it going to take me to do it, multiplied by my hourly rate, because that's